Hello, everyone, and welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Caitlin Cormier. You've probably heard the expression, you are what you eat, but a healthy diet is also about when you eat, too. After all, even as appetizing as it sounds, devouring a triple-decker ice cream sundae probably isn't the best move before bedtime. It's a similar story with investing. What you invest in is very important, but so is where you hold those investments. This is where it can get tricky for investors with all of the most popular accounts: a tax free savings or TFSA, a retirement savings plan or RRSP, and a non registered account. In today's episode, we're going to explore a few common investing scenarios and how to best use each of these accounts to help reach those goals. Of course, there is no one size fits all approach, but there are best practices that can get your portfolio moving in the right direction. Before we dive in, I just want to run through a few of the features of our broadcasting platform to make sure that you get the best viewing experience possible. Within our session today, on the left-hand side, you'll see a whole bunch of resources and links. Please take note of those and click on any that interest you so that you can see them after today's session. In the middle, on the bottom, we have upcoming events. We've got lots of exciting events happening even through the month of December. So go ahead and choose any of those you're interested in and register for them. You'll notice on the right-hand side, we have a live question and answer box where you can go ahead and ask any of your questions throughout today's session. Over on the bottom left-hand side, you'll also see our social media handles. So go ahead and follow those too to make sure that you can stay up to date on everything that is new and exciting with TD Direct Investing. All right, with that out of the way, let's get into our conversation. Joining us is Jonathan Needham, Vice President and Director, Lead of ETF Distribution at TD Asset Management. John, it is great to have you back with us.
Thanks, Caitlin. It's wonderful to be here. Appreciate it.
First off, let's clarify a couple key concepts. So asset allocation and asset location, and these are pretty central to our discussion today. So what are asset allocation and asset location, and how can they be key to investors reaching their financial goals?
Yeah, wonderful. Thank you. Well, let's start with asset allocation. And let's use the food analogy since we were talking. You made me hungry a little bit for your first comment. So I look at asset allocation as your balanced diet, right? What is the right mix of your asset classes within your portfolio so that you don't suffer from indigestion along the way for growing your assets? So what's the right amount of cash, bonds, and equities within your portfolio based on your risk tolerance, your time horizon, and that objective for that money? And of course, asset location is where should we hold those asset classes for the most tax efficient experience so we can better compound that growth of wealth over time.
Love it. I love how you took the theme and ran with it. That's great. So just how influential can the asset allocation and location be on returns over time, or that indigestion piece? So how impactful can these two pieces be?
Yeah, I mean, asset allocation for certainly is the key one I want to focus on today. Getting that mix is going to drive over 90% of the variability of those returns. And so making sure that you've got the right amount of cash, fixed income, and equities in your portfolio relative to those objectives and your risk tolerance, what kind of ride do you want along the way, if you will, is really the most important thing to look at. And then the second component, the asset location, is going to be more important as your net worth grows. So as I said, 90% of the variability of returns is driven by that asset mix. Obviously, the ride, how much ups and downs, is going to be dependent on that mix. And then where we locate those bonds versus the equities can actually add around 20 to 30 basis points of compounding rate of return over time. So that might not sound like a lot, but in my world, especially being an ETF guy, every basis point is sacred. And the compounding growth on those basis points can be meaningful over time, particularly as your net worth grows.
Okay, very interesting. So when we're talking about this, so I understand asset allocation, really, really important. So in your opinion, should each investing account have its own asset allocation, or should investors kind of think of their asset allocation more holistically across all of the accounts that they have open?
Yeah, I think, in an ideal world holistically, and I say ideal because I think it becomes more important as your net worth grows and the complexities of the investment strategies that you employ becomes more important. But out of the gate, asset allocation is going to be the most important component. And simplicity is extremely powerful. So if you're going to, put 95% of your efforts into one thing, it'll be getting that asset mix right. And then you would emphasize the asset location as the complexities and your net worth grows. And so you've got a great portfolio snapshot here, call it the traditional 60-40 portfolio, which has actually truly stood the test of time. There's been a few years where bonds weren't in favor over the last 5, where people have started to question the 60-40 portfolio. But I will argue over a long period of time, it's not only done exceptionally well and allowed you to not suffer from that indigestion, but in the market environment that we're in going forward, I think the 60-40 is going to do extremely well because now bonds are finally attractive again relative to where we were the last 5 years. And so I think getting this mix is extremely important, and that's kind of the first component that we should look at, regardless of the investment account that we're opening up, if you will. And I think I always like to align my portfolios relative to my goals. So am I saving for a house? Am I saving for a vacation? Am I saving for my kids' education? Am I saving for my kids' wedding? What is that dollars for? And that's going to determine the type of risk and asset mix that I'm going to take and what type of account that I will hold it in.
Okay, hold that thought. We're going to come back to some really interesting scenarios, and I'm excited to dive into that. I've had some inspiration in the food genre. So I guess we can kind of think almost as the asset allocation is a bit of like our recipe for success, right? Like these are all the ingredients we're putting together, and we need kind of that right mix to make sure that we're going to be successful. And I think I know the answer to this question I'm going to ask you, but I'm going to ask it anyway. Which do you think should take greater weight in an investor's investment decision, allocation or location of assets?
Allocation for sure. I think it's key is to don't let the tax tail wag the investment dog. I think that's kind of extremely important for everybody to focus on first. And then as you start to get more complex, we can focus more on the asset location. So it's important, but the asset allocation component is the most important. And we don't want to overcomplicate a portfolio and take away from what is driving the majority of the variability or return. So if you have to spend most of your time on getting the balanced diet, that is key. Make sure you're putting the right ingredients into what you're cooking and what you're putting into your body, because we want that portfolio to grow up strong and healthy, just like our bodies.
Love it. Right. Exactly. We're just kind of running with this analogy. It's great. So you brought up the elephant in the room, which is taxation. And as investors of any type or form, we know that taxation can get a little complicated. So can you run us through how different investments might be taxed?
Yeah, absolutely. So I think, interest income is fully taxable at your marginal tax rate. And so if you're thinking about your savings accounts, your GICs, your coupons you're getting from your bonds are going to be fully taxable. And so we'll talk a little bit later, but as you realize that there are ways to put more bonds in a registered account, as an example, versus non-reg, in order to reduce those tax implications. Capital gains are taxed at 50% of the realized gains, taxable at your marginal tax rate. And of course, that's changing. We've just made it a little bit more complicated, relative to the last number of years. We've now got a 2/3 inclusion rate above 250,000. And so it's less efficient, but I would still say capital gains are still going to be the most powerful tool to grow your wealth over time, right? Investing in equities, experiencing the growth of those businesses. And remember, you're only realizing those gains when you're making a transaction, when you're taking profits off the table. And then, of course, we've got Canadian dividend income, which is fully taxable at your marginal tax rate outside of non-registered accounts. But of course, there is ways to recover and get some of those dividend tax credits. And that's why Canadian dividend equities are extremely popular, particularly among retirees and investors that are looking for fairly tax-efficient income. And then the final bucket we'll talk about is the foreign dividend income is also fully taxable at your marginal tax rate and may incur some further withholding taxes. Some are recoverable, some are not, depending on the investment account that you hold it into. So we can get into the weeds if we want to, but this is, I think, a real nice, simple way at looking at the recipe and where we would look at tax consequences based on those earnings within our portfolio.
Right. Having kind of an overview of which things tend to be more efficient than others so that we can make, those decisions if and when we need to, and our, portfolio starts to get a bit more complicated or sizable. Now, kind of continuing down this road, there are different rules for different registered accounts. For example, like the tax-free savings, the RRSP, as well as non-registered accounts. So what are the major differences that investors need to kind of appreciate about these accounts?
Yeah, I think, I mean, the key components is think about the registered account. This is going to give you that tax deferral and that tax shelter. So that compounding growth is going to be even more powerful within a registered account than it will be outside of a registered account. And so extremely important to try to max those out depending on what your investment goals are, and what your risk tolerances will determine the asset mix. But certainly, when I look at myself, I'm always looking to kind of max out my RSP, get that tax deduction, get that tax sheltered growth. And then obviously important to then look at that TFSA, which is a great tool that just came to the Canadian market not too many years ago in my life cycle in this business anyway. And then obviously now the first home time for FSHSA is extremely popular, actually one of the fastest growing accounts in the Canadian marketplace, and extremely powerful to help for people to get that tax deduction as well as tax deferral and aside from tax growth. And then of course, if for some reason you decide you're not going to buy that home, you can transfer that to your RSP without any tax consequences. So extremely powerful that was introduced in the Canadian marketplace, and will help a lot of us buy and or rebuy a home if you've been out of the marketplace for a number of years. And then of course, the other account is where I'll say the secondary is your non-registered account. So as you've started to maximize your tax deductions, invest to fully grow your wealth without negative tax implications, then you're looking to build that non-registered account, which is going to be, it doesn't have any tax advantage to it, but again, investing in the markets will help you grow your wealth over time and help preserve your capital relative to inflation.
Course, yeah, absolutely. It's funny that you mentioned that about the tax-free being a relatively recent. I just celebrated my 15-year anniversary with TD within this industry, and it's been around since I started. But I still think of it as a new account. That 15 years, yeah, it's a long time. It's been
I'm
around
showing
for...
my age. It's all the gray hair. It's just been.
All right. So let's get into a little bit more kind of the weeds here. So getting up to speed with these major account types. So how are different types of investments taxed within these types of accounts? We talked about a little bit of the differences, but kind of getting into the weeds even a little bit more, how are investments taxed in these individual accounts?
Yeah, so the great thing is anything that's registered is tax-free until you decide to take that money out, right? And so your RSP is going to be tax deferred until a time in which you need to draw on that income, hopefully not until retirement. And then it's going to be an income at your marginal tax rate at that point in time, which for many of us is less of a tax burden, a lower tax rate based on our earnings pre-retirement. Not for everybody, but still I would argue, and there's been some studies that have actually shown that it's still one of the most advantageous vehicles to use to grow your wealth, even if you're going to have an income stream in retirement that's similar to your income stream pre-retirement, for those that are fortunate enough to have grown their nest egg and have an income stream of such. And so extremely important, and you can see some of the statistics here. You've got an 18% of your annual income up to a maximum of $31,560. So that's quite a bit of money that you can tax defer and tax shelter on an annual basis, which compounded over time can be extremely meaningful to your lifestyle in retirement. And so again, extremely important to max out those registered plans first, not only to help your wealth grow and compound tax-free, but also to take advantage of tax deductions and that compounding growth effect that the markets provide us. And then of course, yes, you do have a dividend income exempt foreign withholding tax. We won't get into too much of the weeds there, but a lot of folks are looking at, where should I hold my Canadian dividend stocks versus my US dividend stocks versus foreign income generated stocks and or securities like an exchange traded fund. And we can talk about that, but I think what's important here is really trying to take advantage of the vehicles that the government provides us to help us grow our wealth tax-free.
Absolutely. So RSPs, I know sometimes they get a bad rap, but they really, like you mentioned, there's a lot of certainly benefits with them. Even if you do have pension plans, it's always good to build in for yourself as well. What about things like what about the tax-free savings and non-registered? How do taxes work in those accounts?
Yeah, so the tax-free savings account is great because we're contributing to it in after-tax dollars. So we don't get the tax deduction that we would with an RSP to reduce your income proportional to the RSP contribution, but we do get tax-free growth. And when we take it out for whatever purpose we may need and or desire, it's not taxed. And so I think it's been a great vehicle. And one of the, again, I'm actually shocked at the size of TFSAs across the Canadian marketplace now. You've actually seen a lot of us take advantage of this, the TFSA, to help grow and to grow our wealth tax free. So it's been extremely a helpful vehicle for many. And then I think well, we can get into the non-registered side of the equation, but again, you're going to contribute to the non-registered with tax-free dollars. But as you get income, it's taxed at your marginal tax rate, and as you sell, it's taxed at the capital gains inclusion rate that we talked about earlier.
Right. And tax-free savings are a little tricky too, because they don't have that exemption on the foreign dividends that the retirement savings plan has, right?
That is right. You're
US
getting into the
dividends.
details. I love it. That is key.
Sorry,
Yeah.
maybe a little too far. Just you mentioned it on the RSP side, so I thought I just mentioned that on the tax-free savings side, that is a little thing to consider.
Yes,
All right.
definitely the nuances do matter. Absolutely.
Yeah. Okay, let's take a little bit of a quick pause and go for a little bit of fun in the action. One of my favorite pastimes outside of work is trivia. So we're going to do a quick trivia question for the audience. So here is the question. How much was the average combined contribution across registered retirement plans, RSP and TFSAs in 2020? And this is the latest year that's been tracked by Stats Canada. So our options here are 4,500, 6,500, 16,000, or 19,000. So cast your votes for our audience. Go ahead. The poll should be up on the screen there. You should be able to cast your vote. What do you think, Sean? What do you think the answer to this question is?
My default would have been $6,500 out of the gate, but then I see 2020, right? And that was COVID. And we had nothing to spend our money on. We were getting checks, some of us from the government, getting exemptions. So I'm kind of inclined to go either C or D. So just for fun, let's say it's 19,000.
All right. It's true because when we think about that year, there was a lot of bad things happened in that year. That not a great year to remember for probably most of us. But savings, right? There was so much opportunity to invest, in the investing world kind of, there a lot happened. So hopefully that helps lots of people build their wealth during that year. Absolutely. All right. And I'm interested to see, like, what do you think? Do you think the audience is going to be in line with you with this? Do you think we have a lot of contributors here in the audience today? Maybe they're going to be going with D as well. What do you think?
I'm going to guess they're going to go with C or D because I think those were better times. I've seen, inflation pick up, the cost of living gone up, our savings are starting to be depleted. I've seen all the stats. So maybe if I were to look at 2024, 2025, we may be a little bit lower, but I'm going to think they're going to go to the higher end of the equation.
All right, I love this. Okay, let's look at the results here. So it looks like our audience, the majority went for 16,000. The second highest majority was a tie between 4,500 and 6,500, and then only 11% of the audience went with you at the 19,000. And the actual answer is C. Remember, the answer is always C in these multiple choice questions. About 16,000, according to Stats Canada, the tax-free savings was the most popular vehicle with an average contribution of a little more than 12,000, but the RSP wasn't too far behind. So like you mentioned, TFSA is one of your favorite, when we think about the flexibility of it and other sorts of things, it sounds like Canadians are feeling the same way as you, and that's where the majority of their contributions are going as well. So I love your optimism. It's great. Yeah. Your logic was right.
When you think about that, if people were putting that much money aside, I think they were doing themselves a good service because the markets have also been extremely strong. So congratulations.
Hopefully some of that money was put in right in the bottom around March, or March or April, whenever we were really, really low, and they got some really good returns. Okay, let's talk a little bit about these optimization strategies. This is the heart of our conversation, what we really want to know. So, how can we optimize a portfolio across tax free savings, retirement savings, and non registered accounts? Now, a quick disclaimer to our audience, remember, this is kind of general practices that we're discussing for each account. Every investor's circumstances are unique. So, take this discussion as just food for thought rather than financial advice. With that said, let's get into a couple investing scenarios. So, first up, let's say an investor is saving for retirement and their retirement is still 30 years away. What could they consider doing to optimize asset allocation and asset location across RSP, TFSA, and non registered accounts?
Yeah, I mean, I think first up, that's a great time horizon, right? So if you've got a 30-year goal, 30-year time horizon, you can take a little bit more risk, right? Because I don't know, statistically, I'm going to say, the markets drop, once every 5 years by about 20%, but over a long period of time, call it 30 years, you're like a 99.9, if not 100% chance of a positive rate of return compounded over that time frame, even if you were 100% equities. And so I think, again, you're going to get the asset mix is going to be right for you, right? What's the right diet for you? So I think for some that will still be 60-40, despite the fact that they have a long time horizon. But for many of us, higher percentage to equities, particularly the longer time horizon, is a very simple rule of thumb. And so, yeah, as you're younger, a higher exposure to stocks. As you start to approach retirement, you want to reduce that stock exposure, that equity exposure, because you're looking for more preservation of capital. You're looking for better downside protection, if you will, because you're going to need to start drawing on that income. And so you got to think about it as you're, going into your final stages of your career. If your income's going to drop significantly in retirement, which it does for most, you're now going to have to draw from that registered account. And so you want to make sure it's a little bit more stable. And because how bad would it feel if you got that 20% drop in the first year in your retirement? It's tough to recover, right? A 20% drop, you need more than 20% return to get back that amount, right? If the market drops 50%, which it has done historically, not too many times, thankfully, you now need 100% return to get back to even. And so I think it's extremely prudent for folks to think about reducing their risk and be more of a lender to companies and governments versus an owner of businesses as we get into a pre-retirement and retirement stage.
Otherwise, then you become maybe an employee of the company for a little bit longer, as opposed to jumping into retirement, right? And so
Right.
that's our allocation. So we're kind
of
yeah. So that's kind of our asset allocation. And what about location for that time frame?
Yeah, so I think, as you start to get closer and you've now got multiple accounts, right? You've maxed out your RRSP, you've maxed out your TFSA, you don't need the home buyers program anymore because you've utilized it, you've maxed out those tax deductions and that tax compounding growth. Now is where you start to look at, where should I hold vehicles that are going to be more taxed versus less taxed? And I think that's where we start to look at having more of our equities in our non-registered account and more of our fixed income in our registered accounts, because you want to shelter those investment vehicles that are going to be more taxed, if you will. And so I think that's what I've seen, from experience. Having said that, I think simplicity is still key. So if you're looking at, let's just give you a scenario. Let's say you got $1 million in your RSP and you got $1 million in a taxable account. Wouldn't it be ideal if I had $1 million of bonds in my registered account and $1 million of equities, and now I'm 50-50, I'm conservative, I'm looking at preserving my capital, and it's very tax efficient? That's fine, but don't get to that mix by, selling out of your RSP in order to make that happen, because now you're going to get other tax consequences that are going to be punitive. So I guess it's my simple way of saying asset allocation is still more important than asset location. And so we don't want to trigger any unnecessary transaction costs and or necessary tax consequences to get back to the best optimal mix holistically. Having said that, you want to certainly look at owning, call it bonds in your registered account to a higher degree and more equities in your non-registered account for tax efficiency. Because like we said earlier, that could add another 30 to 40 basis points, so call it 0.25%, to the growth of your portfolio over time.
All right. Okay. Very interesting things to consider. We've got a little graph up on the screen too. I think that shows a breakdown there. So that's very interesting. Let's look at the second scenario. So we talked about the idea of moving towards retirement. Let's say that we're actually entering our retirement and we expect that our retirement will last about 30 years. So we've got lots of time, lots of life expectancy. How might you want to split up investments across the tax-free savings, RSP, and non-registered accounts? Of course, we'd be looking at RSP/RIF, right, if we're getting into the income side of our retirement. But how might we want to look at splitting up those investments in retirement?
Yeah, and I think the first thing we should talk about is what you just said: longevity. We're all living longer, thankfully, right? We're living longer. Hopefully, that means we're eating better. Our bodies are healthier.
Hopefully, healthier.
Exactly.
Yeah.
There's been a lot of advancements in technology and healthcare as well. So I think, traditionally we always used to think about, I'll call it a simple rule of thumb, right? If you're 50 years old, they used to tell us you'd have 50% in bonds and 50% in equities. Today, I would argue that's not really a good rule of thumb. You're probably going to add 20 to that number because we're living 20 to 25 years longer. So most 50-year-olds today who can tolerate risk are going to have closer to 70-75% in equities. And so the old rules of thumbs from the perspective of your asset mix have kind of changed. And I think the other component too is, as you're getting ready for retirement, you're definitely going to have more fixed income, more bonds, because they're your ballast to equity volatility. They're going to give you a smoother ride. It's like, I'm going to go on a train ride as opposed to a roller coaster. I think that's extremely important as you start to get towards retirement and within retirement. And then obviously you still need that exposure to equities to offset that longevity risk. And, I can think about personally some family members, not my direct family, unfortunately, but some outside of my family members that have quite a bit of wealth. They might be older in their age and already 15 years into that 30-year retirement, but they're still heavy equities. And the reason for that is because they don't have any risk about living their money. They don't have any risk about spending their money. What they're looking to do is provide a legacy for their children, their grandchildren, and their charitable trusts. And so I think we have to look at that asset mix depending on your needs, your goals for yourself, but the goals for you for, I'll call that your legacy as well. But again, simple rule of thumbs here, we would certainly want to have more fixed income to lower that volatility. We may also want to look at other lower volatility strategies, whether it's a low volatility ETF or a dividend paying ETF strategy, because they're going to have lower beta, lower volatility than the broad market. But we're still going to need that equity kicker so that we have some growth. Growth of income is still going to help. That's what a dividend strategy would do. But we're going to need that in order to live that 30 years and then provide a legacy as we go. And then, start to consider dividend stocks for regular income stream. I know a lot of friends that are approaching retirement and they're starting to look more at like options overlay strategies, in an ETF vehicle as an example for income, REITs, infrastructure strategies that are going to provide a steady stream of income, but with lower volatility than a broad market.
All right. Okay. Yeah. It's interesting to hear. Everyone is so unique. Everyone's situation is so unique. So there's lots of things to consider when we talk about allocation, not just, everyone who's this age should have this allocation. It's not, it's not as simple as that. There's lots to consider. So we talked about a lot of kind of the specifics of different types of investments. And what about location at that time, about that time in your career or life?
Yeah, I think this is where you look and you want to have your bonds and your interest bearing vehicles, your GICs, hopefully your high interest rate savings accounts, your high yielding money market ETFs within your registered accounts, so that you're not getting taxed on that income at your marginal tax rate. And then you're going to want to hold your equities and or some of those more unique equity strategies like real estate investment trusts and dividend earning equities in your non-reg account, because some of those are going to provide return of capital, which are not going to be taxed as well. And then you certainly want to consider your US and your foreign dividend stocks in an RSP, because you're looking at 15% withholding tax as an example. So if you're getting a 4% yield, you're giving up 60 basis points, so a little bit more than 0.5%. And so I think these are some of the strategies you want to start to consider that are going to help you compound that growth as you continue into your retirement.
All right. Another thing that Canadian retirees typically will collect, of course, is some source of income from the Canada Pension Plan, CPP, OAS, Old Age Security, and maybe even the Guaranteed Income Supplement, depending on their income level. How can they consider these sources of income when they're figuring out their asset allocation and location in retirement?
Personally, I don't think they should. They should look at that from a financial planning perspective. How much income do I need to sustain the lifestyle that I want? And that's where they're going to add up, calculate how much that income stream is providing. What do I need to complement that with, whether it's the REITs and the real estate investment, dividend, equities, so on and so forth, in order to get an income stream that's going to allow me to live the lifestyle I want. And for some of us, that's quite simple. We're going to stay at home, spend some time with their family, maybe do some local trips. For others, they're in retirement, they may be traveling 6 months of the year. And so their actual retirement income may be similar and or greater than their pre-retirement income. If they've created enough wealth to do that. So I think that's extremely important. But I think we shouldn't really focus on that other than from a financial planning, balance sheet, cash flow perspective, not from an asset allocation, asset mix investing perspective.
Okay, very interesting. Good to keep in mind. Next scenario, this is one you alluded to a little bit earlier. We're going to get into that first home savings account conversation a bit. So let's say an investor is saving for a down payment on their first home and they're hoping to buy it within 5 years. What could they consider doing to optimize asset allocation and asset location across tax-free savings, retirement savings, non-registered, and now the FHSA? So lots of different accounts to consider. We're talking about maybe some younger investors looking at their first home potentially, or somebody getting into the market later in life after not having owned one. But what does that look like from your perspective? How can we optimize these different types of accounts and benefits?
FHSA, which I can never say properly, first. TFSA second, and then non-reg third. I shouldn't say that. I guess RRSP, the first time home buyers plan, just remember you're going to have to pay that back, right? And so I think, in order, it's going to be the FHSA, the TFSA, the RRSP, and then a non-reg. So I think that's, in terms of investment accounts, that's the most important. And then based on our discussions earlier, you can do your asset mix relative to a tax efficiency perspective. But pay less attention to that because it's only a 5-year time horizon. And so I think, being a 5-year time horizon, as I mentioned earlier, the markets drop 20% once every 5 years. And so you want to keep that in the back of your mind, because it could be in that 5th year, you've had a great compounded rate of return, and now you're ready to buy the home and you've saved maybe $150,000, a 20% hit's going to hurt. And so I think that's key for folks to understand. And I say this because I have a lot of millennial friends and a lot of younger friends that have taken their investment accounts and taken large bets, and it's served them well. They got lucky, I would say. They invested heavily into, let's say, a technology ETF as an example, and they had great growth, and that allowed them to buy a better home than they would have otherwise. And so they feel really good about themselves. But I've also seen, I've been in this business for almost 30 years now. And I've also seen the opposite happen, where, clients have taken a little bit more risk than they probably should have. And now they have to defer that home that home purchase for a year or two. And that's a real emotional drain, and also can put an impact on our lifestyle. And so I think it's really important. It's going to be individualized again. But I think having a balanced approach, a balanced diet, particularly if you're only 5 years out, you certainly want to make sure there's a lower volatility and a preservation of capital component to it. So yes, you're probably going to own a little bit of cash, GICs, and or bonds, even better, within your portfolio, to make sure you've got that ballast to the equity volatility.
I think sometimes, especially for people who were investing in the market from like 2009 forward, it almost felt like you were invincible. No matter what you invested in, you were doing well. And then things kind of came in, more reality checks came in more recently. So I can see how, a lot of us got away with being a bit more risky with stuff just because everything was going up. But yeah, no, it's definitely something that you have to have a flexible timeline. If you're going to take the risk, you can't need that money tomorrow, right? Or else you're really going to
Yes,
Well, nowadays you
there's
just won't be able to get a house, right? With house
you won't be able
pricing
to
the
get
way it
it.
is.
Yeah,
Yeah.
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 I think
There goes
there's a
your
saying in the investment there's a saying in the investment world: the only free lunch is diversification. And so I think that's important for people to realize. And this is a great snapshot right here as to where you want to hold the cash and the bonds and the interest-bearing vehicles versus the equities. And again, it's going to be personalized. But if you are going to take a heavier equity bet, at least make sure you're taking advantage of that diversification free lunch, not even just from an asset class perspective, but even within your equity bucket. Try not to, I'll say make a concentrated bet on a small number of securities. Make sure you're diversifying that as well, both from a geography perspective, a sector perspective. That's extremely important.
right. Absolutely. Okay. Our fourth scenario, I like this one the best. Let's say an investor is saving for a vacation that they would like to take in a couple
Mm.
of years. This is not necessarily specific to me, but I may take some of this into consideration. So, how might you want to split up investments across those three accounts for something like that?
Are we going camping, or are we trying to go to Hawaii? I mean, I think this is the challenge.
Think a little bit more
Yeah,
glamorous than camping, glamping at least.
yeah. I think there's a couple things. I think first, dollar cost average, right? Save every month. They always say pay yourself first, save first. That way, it's not impacting your key responsibilities and your lifestyle. And so, if you pay yourself first and you save first, then you'll know maybe I can't do that fancy dinner this weekend, but that's actually going to be rewarded because now I'm going to be going to Hawaii as opposed to camping, right? So I think that's key. I think the other component is to consider a higher exposure to bonds, to fixed income and cash. And the good news is today we actually can. If we were having this conversation a few years ago and bonds were yielding zero and cash was yielding zero, we would be saving, but we wouldn't be getting any growth on that savings. So we'd be putting our money aside for that great vacation. The good news is today, if you're saving, you're actually finally being rewarded again for saving. We're actually getting 4% returns on cash again for now, until rates go down a little bit further, but for now. And then bonds too are giving you coupons of 4 or 5%. Plus, there's some capital gains opportunities because we're in a different rate environment than we are today. So I think that's key. Is you want to keep it pretty conservative, deposit-like instruments, maybe only a sprinkle of equities, and again, a diversified equity ETF as an example. And then here, you want to make sure you're deferring that tax, right? That growth on that money, TFSA is going to be a great vehicle for that.
I was gonna feel like a real estate agent saying location, location, location afterwards. But yes, you got it right. Tax-free savings probably makes the most sense with that, just with the benefits of being able to not have to pay tax when you take the money out and that sort of thing. Okay, awesome. Um, Talking through these different scenarios, we may have some investors in the audience thinking, okay, maybe I need to rethink some of my asset allocation or move things into different accounts. What are some of the best practices they could consider before making any of those kind of changes to their portfolios?
Yeah, I mean, you want to look at what are your transaction costs going to be. You don't want high transaction costs and high friction costs. So I think the first thing, and most of us do this throughout the year, many of us do this at the end of the year, come to December, is, are there any losses within my account that I can harness by selling those securities today? And so you want to do that on a regular cadence, if you will, and build, don't want to be building up losses. Hopefully we're always in gain situations. But in a year like this, where the markets have been exceptionally strong, we may want to lock in some of those gains that can be offset by past losses. So I think that's certainly a key tax consideration to do. I think I mentioned this earlier, but if getting your asset mix to that right balanced diet is important, do it, but don't do it at the expense of withdrawing from an RRSP, because that's going to have a more negative impact than getting that asset mix back to its appropriate mix. What's better to do is just have new contributions and future contributions put towards the asset class that you're now underweight. And I think, this is a perfect example this year. Many clients are going to end this year overweight equities. Equities have done exceptionally well globally, particularly the US equities. And so clients are probably overexposed to the equity market today than they were 2 years ago. And so rebalancing is key, but don't do it if there's high friction costs, and or don't do it at the expense of pulling out an RSP. Find some new money and put it to work to rebalance that portfolio. I think that's key.
All right. Okay. I think that's some really important considerations. So nobody goes out and makes rash decisions right now. There's a couple different things we can consider to sort of get in line that way. Not just me, others probably are also saving for multiple financial goals. Of course, retirement is always the dream, vacations, renovations, all the things that come along in life. What are some ways that we can simplify the process as you figure out what the allocation is across the various different accounts?
Yeah, I mean, yeah, I think today and I think most of our investors, thankfully, are taking this more goals-based approach. What is this dollar meant for? What's this bucket meant for, right? This is meant for retirement. This is meant for fun. This is meant for my kids' education. And so, getting the asset allocation mix appropriate based on that time horizon, that risk tolerance, and that objective for that money, again, reinforced, that's number one. And then number two, we look at holistically, how does our asset mix look across our larger accounts in particular, our non-reg and our registered accounts in particular, RRSP and our non-reg, our margin account. And is there any ways for me to make sure I own more of the interest-bearing vehicles in my registered account and more of my non-interest-bearing vehicles in my non-registered account? And can I do that in a way that's not going to impact me negatively from a transaction basis? Something obviously less than that 20 to 30 basis points of value that we're going to add. And so I think I think from an investor perspective, focus more on what's the goal, and let's align that asset allocation mix to that goal and that time horizon. Let's get that right first.
Okay, perfect. So we really have to kind of understand what we're saving for and then make our decisions. Don't jump into investments first and then think about what the reason for it is and to make sure that we're matching that goal and the investments together. I love that. Okay. Before we continue, I do have a quick question for our viewers. Are you enjoying the show so far? Then make sure to subscribe to TD Direct Investing's YouTube channel. And if there's a topic you'd like to learn more about, let us know in the comments. Plus, follow us on Instagram at TD_Direct Investing to get a sneak peek at upcoming shows and a ton of other content designed to help you build your investing knowledge. I always like to shout it out. If you want to see my dogs, they're absolutely adorable and they're in one of the videos online. So go check it out on our Instagram. Yeah, that's a pretty fun video we have, and my dogs are in it. So super exciting for me too, as a dog mom. Okay, we are going to hop in and take a look at a tool that will help to optimize a portfolio across some of the popular registered accounts. So this is this is our asset allocation tool we'll be able to see. So let's kind of hop into Webroker and show our viewers how they can put this into place. Okay, we're going to look at one of the tools on Webroker to help you with your personal asset allocation in your account. We're going to come under account details and go to the third option here, which is asset allocation. This particular tool is going to help you by actually showing you what the breakdown is within your account of different allocations. So you can see here it's broken into Canadian, US, and international equities. It's also broken into fixed income, both Canadian and global. Then we have cash and cash equivalents, other, and unclassified. This particular tool, if we scroll down a bit further, we'll see that those individual categories are actually broken down a bit further into individual drop-down menus. So if I click, for example, on the Canadian equities, it will show me all of the different securities that fall under Canadian equities within this particular account. You'll notice here towards the top that I also own multi-class asset class funds in this account, which means some of the funds might show up under multiple categories, meaning they have both Canadian equities and US equities within them, or for example, fixed income and equity together within that one fund. So it shows up here as well as within another category of this account. One of the ways this can really help you as an investor is it can give you a quick, easy look at what your portfolio breakdown is, and then you can go ahead and make any changes that you might need in order to bring your asset allocation in line or change it to an asset allocation that might work better for you. All right. Hopefully that's helpful for our viewers in kind of making sure their portfolios are in line with their goals. Now, we're going to leave the interview portion of our conversation there, but we're not done yet. We're going to open the floor and take some questions from our viewers. So, John, are you ready to hear what our audience wants to know more about?
Sounds great. They probably just want to know more about your dogs. That's what I'm thinking about. Can't wait to go and check out their Instagram.
It's funny. They're all over Instagram, so you'll find them there. Okay, we have a question here from Kenneth. Surprisingly, not about my dogs. If you have a REIT ETF, is it best to keep it in a tax-free savings, RSP, or non-registered? So we're getting a little more specific on investment type here, and you quickly mentioned REITs. They are kind of interesting little investments. They've got a lot of kind of unique features that other investments don't have. But in general, kind of course, not advice, just a general comment. How do you kind of feel about where REIT ETFs could go?
Yeah, great question. So first off, I'll tell you, I'm a fan of REIT ETFs because real assets, whether it's real estate or infrastructure, is a good diversifier in a client's portfolio. It's actually an asset class that it has a fairly high correlation to equities, but tends to have I'll say it helps bring the volatility and the risk-adjusted returns better than if you didn't have that exposure. So first off, they're a good addition to a portfolio. They are fairly high correlated to equities, broad-based equities, but they're a good diversifier nonetheless. The second thing I will say is a lot of clients do own them in their taxable accounts, in their non-registered account, because they provide an income stream and a fairly tax-efficient income stream because there's a return of capital component. So I think the short answer is REITs have a place in a portfolio regardless of the account, but they certainly are more heavily weighted in a taxable account, particularly for those that are looking for more stability, lower beta, lower volatility, and for a tax-efficient income stream.
All right. Okay. Lots to consider there. We have another question. This one is coming in from Jonathan. I have 7 figures invested in 2 asset allocation ETFs. They have some symbols there across TFSAs, RSPs, and taxable accounts, giving me a 70-30 stock bond mix. Asset allocation ETFs tax efficient if they are held across multiple accounts?
Yeah, I mean, congratulations. I mean, these asset allocation ETFs that are in the marketplace are exceptional. I mean, they're one-ticket solutions, they're low cost, they're rebalanced on your behalf back to the asset allocation mix, either quarterly, semi-annually, depending on the provider. I can see which ones you own here. I know them well. So first off, I think, for all of our listeners out there, these are great solutions that are going to give you the free lunch that I mentioned earlier, fully diversified across geography, across asset class, and give you thousands of securities in a single ticket. So great way to build your wealth and a great balanced diet, if you will. One that will, I can confidently tell you, be a great compounding growth story for you if you continue to just add those over time. And are they tax efficient? Yes, they are. They're extremely tax efficient because, first of all, most of these asset allocation ETFs, and specifically the 2 that you mentioned, are 100% built with passive ETFs, so index solutions. So you're getting market returns, and when you're owning an index, which is you're taking an ETF that's making an index and investable into an investable security, there's not a lot of turnover. And so very tax efficient because you're not going to get a lot of capital gains distribution. This year you might get a little bit because we've had an extremely strong equity market, but you're going to get fairly little capital gain distributions at year end because there's low turnover in a passive investment solution. You've got a low cost vehicle to get you market exposure. And so as I mentioned earlier, every basis point is sacred. When you're investing in a strategy like this, you're keeping more of your money as opposed to paying high fees. And so I think a 70-30 portfolio, as these things offer you, a little plug, TD Asset Management also offers them in the marketplace, and they're exceptional, are great solutions for you to get tax efficiency and a balanced diet.
All right, very good. Of course, we can't provide specific investing, recommendations or anything like that, but just in general, those types of investments, for sure, they are that, you put $50 in and it's diversified over so many different things. So very low cost to actually get in. Congratulations to our investor who's obviously done well with their investing and savings. But you can start with as low as, small dollar amounts and get invested and diversified kind of right away. So that's definitely a key there.
Okay. You can even do even dollar amounts now because of the fractional share availability on TDDI. So I think this is exceptional. Now we're in a situation as an investor where we can have a dollar amount in mind and we can actually get allocation to a security, including an ETF like this. So I think kudos to TD for being able to give that to our clients now, simplify their lives.
I'd love fractional shares being able to just choose a dollar amount to invest instead of calculating out the number of shares. Yeah, so that's a great shout out too. I love that's a great feature we have on our platforms as well, direct investing. So thank you for reminding me of that. Lori has a question. I hear this all the time whenever we talk about tax-free savings. This question always comes up. Are tax assessed on active/day trading within a TFSA?
Ooh, good question. No, so you can actually transact significantly within a TFSA and it's still sheltered. Having said that, there are some unique scenarios that have been challenged in the Canadian marketplace. I'll say, anomalies, big anomalies. So there have been scenarios where somebody has taken a TFSA, done multiple transactions within it, and grown it to multi-millions. And the CRA has questioned how they've grown a small dollar amount to such a large extent, and prove to me how you did that, and challenge that. And so that's, again, for the less than 1% tile in the marketplace. But I will also still say, though, be careful with how much trading you're doing, because there is still friction costs involved. So if you're trading to express your views, if you're trading to get your asset mix back to its appropriate mix, whether it's a rebalancing perspective, and you're doing it from a reasonable low cost perspective, thankfully which you can do on TDI, then it's reasonable. But again, I always think of too much trading is like a bar of soap. When you wash your hands too much, then eventually the bar of soap disappears. So just be cognizant of those trading costs. But from a tax perspective, you're fine.
Never heard that analogy before. I'm going to put that one in my back pocket for use in the future. I like that, the bar of soap. Jana has a great question here too. We kind of briefly touched on it with REITs, but could you explain the benefit of ROC, or return of capital, and its tax efficiency?
Yeah, so return of capital is just providing you your own money back, and so you can't be taxed on that. And so REITs are an example of providing RAC that's tax efficient. Having said that, there are other investment vehicles out there. Sometimes there's ETFs and mutual funds that would pay a return of capital. That can be a good thing for some, but not always a good thing for others. And so it's going to be very personalized to you. So receiving a return of capital to satisfy an income stream that is required or desired is nice. But you also got to remember that if you're getting your money back, your adjusted cost base is going lower over time, will eventually hit zero, and now you've got a capital gains that's hitting you all at once. And so when you are starting to use return of capital investment vehicles, you are going to be doing it for tax planning. And so do your research and/or consult a professional in order to make sure you're maximizing that, and not just deferring your tax today for a larger tax bill down the road that may be more harmful than you had anticipated.
Yeah, absolutely. We're getting into the weeds a little bit here, because we are getting into this, and it can be very, like you said, specific to individuals and their situations. But yeah, return of capital is important to understand too, because when we're talking about non-registered versus registered, sometimes that would be something you'd look at, and that's certainly in a non-registered situation where it might potentially be tax advantageous to look at that. Lucinda has a question here around location of different assets. So is it ideal to keep the US stocks and ETFs in an RSP? Even Canadian ETFs with US stocks are better in an RSP when talking about taxes. So I think this is alluding to that conversation we had about kind of that exemption on US or foreign stocks within the RSP, that you don't get taxed on them. So do you have any kind of perspective around this?
I do, yeah. So yes, what you've said is correct. Your question, you're answering it yourself, which is true. The one thing there's always a caveat with this type of thing, right? And so you got to look at the offset. So simplistically, yes, you certainly want to own your U.S. stocks and ETFs within your RSP. Going to be a little bit more tax efficient, 100%. Having said that, sometimes if you're buying a U.S. listed ETF and/or a U.S. listed security, you're paying FX costs, the currency exchange costs to do that. And so in some cases, it can be as high as 1%. And so that may actually negatively impact your returns greater than that 15% withholding tax on the dividend yield. And I'll use an example, the S&P 500, I won't get this number exactly, but if you own the S&P 500 or an ETF that owns the S&P, replicates the S&P 500, your dividend yield is only like 1.25. So we're talking about a 20 basis points tax drag. Well, that tax drag in a non-reg is recoverable. If you own the U.S. listed, you're right, it's more tax efficient than owning, something other than that. But did your FX costs cost you more than that tax drag? And so I think this is why, Canadian listed ETFs continue to grow and gather assets from the Canadian consumer, because we're doing that. The asset manager is doing that currency conversion for you at like 0 or 2 basis points, and not passing those fees on to you. And so a lot of nuance and details here. So I think there's certainly want to do some research if you're really going to focus too much on the nitty gritty here. There's lots to think about.
Right. And of course, the larger your portfolio gets, the more you have to, you can think about these things, the more it makes sense to think about these things. And it's a good problem to have. I always say, if you're paying a lot of taxes, it means you made a lot of money. I know it's a hard, it's a hard position to be in, but usually it means that you made a lot of income if you're paying a lot in taxes. So it's kind of a good problem to have.
You've nailed it. And Caitlin, I've dealt with investors of all sizes, right? From $5,000 to $500 million. And I think, there are scenarios where there's individuals that are extremely high net worth, and they want to own Canadian domiciled product that owns foreign investment vehicles so that they don't own foreign property. And so, because that can open you up to other tax consequences. And so there are obviously lots of things to consider as your net worth grows.
All right. Very interesting. We have a question here. This one is from Aaron. And the question is, we're getting into the weeds here. Would I trigger the superficial loss rule if I sold a stock in my tax-free savings or RRSP and then bought it immediately after in my non-registered account? So I think you're going to have to break down the superficial loss rule quickly here for our audience, just in case they're not familiar with it. I'm going to let you take that one.
Sure.
And then the idea of kind of purchasing it. So I guess maybe that's a little bit with the reallocation, trying to switch the portfolio up, getting creative there. So let's hear your thoughts on this one.
Great question. So the superficial loss rule is if you're going to sell a security to incur and harness that loss, you have to wait 31 days before you repurchase it. And so that's something that's really important to consider. Because if you did repurchase it prior to the 31 days, you can no longer consider that loss. Now, this question is, if I sold it in my TFSA and my RSP and then bought it immediately after my you know what? I actually don't know the answer. I might have to go to Google for that one. I'm not 100% sure. I'll have to leave that one for you to do some more research. I probably should know that. I've never done it myself for that purpose. But also keep in mind, if you if you're selling it within your if you're selling it within your TFSA or RSP, you're not actually going to harness that loss, right? So you're only going to be able to capitalize on that loss if it's within the non-registered. So the question would actually be reversed. Would I trigger the superficial loss if I sold the stock in my non-registered account and then reinvested it prior to 31 days in TFSA RSP? I don't know the answer. But in this case, you're not actually going to trigger a superficial loss if you sell something within your TFSA or RSP. And so there's another example of, I'll say personal war stories from my early investing career. Is sometimes people always think, I'm going to take a high flying risk in my registered account because I got a 30-year time horizon. Well, guess what? If you take a concentrated bet and it doesn't work out, you can never recover that loss and capitalize on that loss. So if it's actually better, it's never a good idea to take too much risk, particularly if you can't tolerate it. But taking risk in a non-registered account is probably the better approach, because if you're wrong, you can harness that loss. If you're right, I don't mind paying taxes if I'm in a gain situation.
Again, it's a good problem to have if you're gaining so much money from a right decision, then and you have to pay tax on it. That's not so bad. It's at least you've got the benefit of having made the right decision and had a win. It's been a very fun conversation. It's really interesting picking your brain. You have a lot of very interesting perspectives, and I think our audience will also appreciate that and the assistance in kind of navigating the investing, allocation, and location world. Do you have any final thoughts for our audience that you'd like to leave us with?
Sure. I mean, first off, Caitlin, thank you today. Been a wonderful host as always. Thanks for everybody who's tuned in. I think if you leave with anything today, I think asset allocation matters, and that's what matters the most. Have a balanced diet. Make sure your portfolio can grow up strong and healthy as your body would with a balanced diet. And I think look at asset allocation. I think it's important. 30 to 40 basis points of compounding growth over time is key, but it's going to be more important to you as your net worth grows and the complexities and the multiple accounts that you have over time. And that's where it becomes more important. So focus on your goals, focus on that right asset mix, and focus on dollar cost averaging over time in order to compound your wealth.
All right, I love it. For our audience, make sure to register for any of the upcoming events that you're interested in. We also have a survey. We would love to have your feedback on today's session. Let us know what you thought and what you'd like to see in the future. Don't forget to follow us on social media and go see my two dogs on that video, as I mentioned before. And hopefully we will love to see all of you in a future session. Thanks again, John. Really appreciate it. And for everyone else, we'll see you next time. Bye, everyone.
Have more questions? Check out the links to the right and in the description below.